Franklin Resources stock, ticker symbol BEN. This dividend income stock is down 22% year to date, underperforming the S&P 500 big time, which is up 15%. And BEN stock reported a miss on EPS, but a beat on revenue. And for the upcoming earnings, most analysts expect a miss. People love BEN stock for different reasons, and one of them is the dividend. And I understand why with dividend yield at 5.5%. However, if we take a look at the total returns in the past 5 years, we see that BEN stock returned minus 17%, versus the S&P 500 returning 101%. And that's a big difference, also because it is including dividends. But could this be the perfect time to buy BEN stock? Well, by the end of the video I will give you my 3 price targets, so make sure to stay tuned and see how I build up to these price targets. I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does BEN do? Franklin Resources is a financial holding company that operates as Franklin Templeton Investment. Together with its subsidiaries, its offering comprise a range of investment solutions such as equity, hybrid, fixed income, alternative investment products and mutual funds. Diving into the earnings, we see that the assets under management was reported at 1.6 trillion, up almost 16% year over year. And this is one of the most important numbers here, so this looks really good to me. Revenue was reported at 1.6 billion, up 9.4% year over year, also looking pretty good. However, the operating income was reported at 420 million, down almost 5% year over year. And this is something that worries me a little bit. EPS is also down because of that. And we see that operating margin took a big hit year over year and quarter over quarter. Definitely something to keep your eye on. Looking at the diversification, we see that asset class is looking pretty good with equity and fixed income being the biggest. Looking at client type, we see an almost equal distribution with 52% for retail and 46% institutional. US represents 70% of the assets under management. And after that, EMEA is the biggest with 13%. Looking again at the operating income, margin and EPS, we see that all 3 came down a lot in the recent quarters. According to Franklin Resources themselves, this is related to the start of the calendar year and the acquisition of Putman. Should increase the margin a little bit here. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. BEN stock is a 11.85 billion market cap company. PE ratio is at 13, which could indicate that they are undervalued. Later in this video I will show you my 3 price targets for BEN stock, so make sure to watch until the end. Revenue is at 8 billion and in this graph we see that revenue went up and down a lot over a longer period of time. This is something that I don't really like. I prefer a much steadier pattern here. And it is the same story with the margins. It is really going up and down a lot, and the trend line is only going down from here. To me, this is a potential red flag. For the EPS, it is pretty much the same story. To me, this doesn't look really good. Analysts expect that EPS will increase at a decent pace in the coming years, but again, it is not really steady and consistent. For the revenue growth, it is looking a bit better, with roughly 6 to 8% growth per year. Return on assets is reported at 3%, which is a low number. The return on equity also looks really low at almost 7%. And the most important number here, return on invested capital, is sitting at 2.8%, which is again a really low number. And it is also lower versus the 5-year average, so that's also not a good sign. Current ratio is at 1.8, which is a great number, nothing really special to add here. But here comes the great part. Right now, Ben stock has 4 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Ben has 3.3 billion in total cash, so they can pay down almost all of their debt without any problems. This is really impressive and comforts me a lot. But still, it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going down lately. And on top of that, historically it is also going up and down a lot. I think it is again the same story here with this company. Shares outstanding are decreasing, which is something that I really like. The most recent increase is because of an acquisition. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 5.5%, which is a great number. Annual payouts at $1.24 and payout ratio is at 45%. I prefer 50% or lower, so right now they have 55% left in cash to pay down debt, do acquisitions, buy back shares and all other things. The 5-year growth rate is looking really decent at almost 5%, but they have no consecutive years of dividend increases. And if you take a look at these numbers, the dividends paid since 2015, we see that Ben stock always increased the dividends at a decent pace. However, since 2022 they decreased the dividends, which is not a good sign of course. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. In here we see that payout ratio is looking pretty good between 30 and 50%. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase at a decent pace from here, which is really nice to see. And overall these dividends look really good to me, but how about the historical returns? I decided to compare Ben stock with the overall market. In this case, the S&P 500. Next to that, I added T row stock. On the 5-year chart we see that Ben stock massively underperformed the S&P 500. In total, Ben returned minus 17%. And keep in mind this is including dividends. The S&P 500 is at 101%. T row also did not great, but at least had a positive 32% return. On the 1-year chart it is pretty much the same story with Ben stock again underperforming the other two in this list. In fact, Ben stock is at minus 9%. On the 6-month chart it is again Ben underperforming the other big time with minus 21% return. On the 1-month chart it is again Ben stock at a negative return, so we see a pattern here. Bottom line, the S&P 500 was the better choice in the long run, but also in the short run. But could this be the perfect time to buy Ben stock? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 2, 4 and 6%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm putting in 9, 11 and 12%. For the free cash flow margin I put in slightly higher numbers. For the PE ratio and the price to free cash flow I'm putting in 10, 12 and 14. My desired annual return is 12.5% since I get an easy 10% average annual return with owning an ETF. Right now, Ben stock is around $23. I hit analyze and we see a lot of red numbers. We have a low price target of $13 to $15. We have a mid price target of $20 to $22 and we have a high price target of $29 to $31. And to me, the mid price target is the most justified here, meaning the stock is trading around their fair valuation. So what do you think is the most justified price target here? Let me know in the comments down below. My final conclusion on Ben stock is that it is an interesting company. However, they are facing a few problems. I think they really need to focus on performing on a steadier level in order to be an attractive investment. Right now the margins, revenue and free cash flow are going up and down a lot. If they are able to fix that, then it might be an interesting play. I really like the current cash position and that they are capable of paying down almost all of their debt. Next to that, they did an acquisition recently, and it would be great if they did more acquisitions in the coming years, in order to be a bit more steadier in performance. From a dividend point of view, things look pretty interesting. I think the yield on its own looks really good, but again, the lack of growth is something that worries me here. What is your take on Ben stock? Let me know in the comments down below. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.